Hello, I'm John A.G., and you can feel it before you see it. That subtle shift when a market stops behaving like numbers on a screen and starts behaving like emotion. Not excitement, not fear exactly, but something tighter, heavier, like pressure building behind a sealed door. Silver didn't just rise today. It snapped attention back to itself and reminded a lot of people that timing regret is one of the most expensive emotions in finance. This wasn't a polite move. This was the kind of move that forces you to sit still and ask yourself whether you actually understood what you owned or whether you were just renting it until the first uncomfortable headline showed up. Because this wasn't a normal rally. This wasn't the slow grind higher that lets everyone feel smart together. This was fast, sharp, and unforgiving. The kind of day where people who sold recently don't even want to open their trading apps. And when silver moves like that at the same time, gold starts acting like it no longer needs permission. That's not coincidence. That's a signal. Markets don't send signals with words. They send them with pain. And the pain today landed squarely on sellers who thought they were being cautious. A lot of people want to frame this as a simple price spike, something to explain away with a headline and forget by next week. That's comforting, but it misses the real story. This move is not just about buyers rushing in. It's about sellers realizing all at once that they may have exited something that is structurally harder to replace than they thought. That realization doesn't stay quiet. It turns into urgency, and urgency in a thin market doesn't knock. It kicks the door in. Here's the uncomfortable part that doesn't get talked about enough. When you sell a physical asset in a moment of fear, you don't just lose exposure to price. You lose optionality. You lose position. You lose the ability to sit calmly while others scramble. And when price moves higher after you sell, the damage isn't just financial, it's psychological. Buying back feels like admitting failure, so people hesitate. That hesitation creates a feedback loop where regret turns into fuel for the next leg higher. That's not theory, that's behavior. And behavior is what moves markets at the margins. But there's another layer to this that rarely gets airtime, especially in the United States. The metal that gets sold doesn't disappear, it migrates. It flows toward whoever was patient enough, liquid enough, and emotionally detached enough to wait for someone else's fear. Recent market data and dealer updates have made one thing clear. Demand outside the U.S. has been intense. In several international hubs, the local price for physical silver has been running meaningfully above what many Americans see quoted on their screens. That gap matters, not because it guarantees future price, but because it reveals where the real struggle is taking place. Not in headlines, not in tweets, but in delivery. Now, whenever premiums get mentioned, some people immediately assume conspiracy. That's lazy thinking, and it's not helpful. Premiums can widen for a lot of reasons. Shipping bottlenecks, local taxes, sudden demand spikes, inventory mismatches, even short-term stress and dealer hedging. None of that is mysterious. But when premiums rise across multiple regions at the same time, and they don't immediately snap back to normal, that's when you should stop dismissing it and start asking a better question. Is the market briefly tight, or is it quietly tightening? Because those are two very different things, and the second one has consequences. The reason this matters is simple. Tight markets behave differently when new buyers arrive. They don't offer liquidity politely. They ration it. And that's when price stops being a suggestion and starts becoming a negotiation. This is why the loudest voices telling you silver is already too late are often the same ones that quietly accumulate on pullbacks. Calm buyers don't shout. They wait. Emotional participants, on the other hand, are predictable. And predictable behavior is easy to exploit. So let's ground this in something practical because confusion thrives when mechanics aren't explained. In the real world, buyback prices don't work the way most people assume. You'll see a spot price, then there's a bid, and then there's what a dealer is actually willing to pay you, which usually references that bid, not the headline number. That difference isn't automatically dishonest. It reflects the cost of immediate liquidity. But in fast-moving markets, that spread can widen aggressively. Sometimes it's protection, sometimes it's opportunism, and sometimes it's a warning sign that liquidity behind the counter is thinner than advertised. This is why walking into a single shop, taking the first quote, and walking out is one of the fastest ways to make an expensive mistake. Physical metals are not a convenience transaction. They reward patience and punish haste. If a shop suddenly refuses to buy, that doesn't mean nobody wants silver. Often it means that shop doesn't want the risk of replacing inventory at a higher price or doesn't have the cash flow to manage rapid turnover. That's not a demand problem. That's a balance sheet problem. In hot markets, you'll see interesting distortions. Government-minted coins might trade with modest premiums because buyers peg bids to wholesale pipelines. Generic rounds might command higher bids simply because they move easily in bulk. Large bars can show tighter spreads because weight matters more than branding. None of this is about rarity. It's about velocity. And here's the trap. When people sell in panic, they often surrender the premium on the way out. Then if they try to re-enter, they pay that premium again. That's a double toll, and most people don't realize they paid it until it's too late. There's also a persistent rumor that resurfaces every time silver moves, that nobody is buying, that shops are full. This claim almost always traces back to one person's single experience at one location. In reality, during fast markets, buyers don't disappear. They become selective. They bid aggressively for what they can flip quickly and defensively for what ties up capital. That's triage, not collapse. The only way to understand the real picture is to compare multiple buyback offers across different venues, including online buyers who publish live bids. The spread tells you how stressed the pipeline really is. Sometimes premiums compress even as price rises because dealers are trying to keep product moving. Other times, spot holds steady while premiums surge because physical supply is strained. Both scenarios carry information. Neither justifies panic. Clarity always beats speed in these moments. Now let's talk about something deeper, because this rally didn't appear out of nowhere. A quantitative analyst recently walked me through a framework that helps explain why numbers that once sounded outrageous suddenly enter the conversation. It's rooted in probability, not prediction. Most outcomes cluster near the center of a distribution. As volatility rises, the distribution widens. In calm times, extreme outcomes are rare. In stressed times, the tails wake up. That doesn't mean extremes are guaranteed. It means they are no longer unthinkable. When volatility stays elevated and a confidence shock enters the system, behavior changes. Sellers stop selling dips, buyers start buying them, liquidity thins, and what once looked like a statistical outlier can begin behaving like a plausible path. Not permanently, not linearly, but long enough to shock anyone anchored to old assumptions. That's how markets break expectations without breaking logic. Across trading desks, the same theme keeps surfacing. Early negotiation of large industrial orders, subtle rationing behavior in retail channels, adjustments in derivatives margins, silver-linked products trading with unusual dislocations, different headlines, same undertone, stress. And stress rarely confines itself to one asset class. It bleeds into bonds, currencies, and digital assets alike. These are the moments when markets collectively ask a simple question: what do we actually trust? I'm not here to push fear or certainty. I'm here to slow people down before they do something irreversible. Because when markets move like this, the biggest losses don't come from being wrong. They come from reacting without a plan. And the story unfolding in silver right now is bigger than a chart. It's a test of confidence, liquidity, and patience. And this chapter is far from finished. When markets enter this kind of phase, it's tempting to stare only at price and forget the machinery underneath it. But price is just the surface expression of stress, and the real story is always happening below the waterline. One of the most misunderstood ideas right now is how extreme numbers even enter serious discussion without the whole thing being dismissed as fantasy. This is where probability replaces prediction, and where people who only look at charts often get blindsided. The analyst I spoke with framed it in a way that strips out the drama. He said, stop obsessing over price targets and start watching volatility, because volatility determines how far price can travel, not where it should be. Think of volatility as the market's emotional range. When that range expands, outcomes that once felt impossible move into the realm of plausible. That doesn't mean they happen automatically. It means the market has permission to explore them. This is where expected move frameworks come in. They aren't crystal balls, they're maps. You take a defined time window, measure recent volatility, and project probability bands forward. The first band captures the most common outcomes. The second band covers the vast majority of outcomes. And then there's the outer band, the tail, the zone people laugh at, right up until stress forces the market into it. In quiet periods, tails stay quiet. In periods like this, they don't. So when a large number gets floated under a stress scenario, it's not someone throwing darts. It's someone acknowledging that under elevated volatility, the distribution widens fast. Behavior shifts, sellers hesitate, buyers step in earlier, liquidity thins, and suddenly paths that once required extreme assumptions now require only persistence. Not certainty, persistence. Picture uncertainty like a cone extending into the future. The farther out you go, the wider the cone becomes. When volatility rises, that cone widens faster. Silver by nature has a wider cone than gold. It's a smaller market, more sensitive to flows, and historically prone to overshooting when sentiment flips. That's why it feels like silver teleports. It doesn't. It accelerates through a space most people weren't watching. Professionals use these frameworks to structure risk, options, spreads, defined exposure. But without risk control, probability is dangerous. For most people, the value isn't in trading the tail. It's in understanding that tails exist, so you don't emotionally implode when a large candle prints. Understanding range keeps you rational. Zoom out, and this ties directly into the broader macro backdrop. This isn't just a metal story, it's a compounding system story. When governments run persistent deficits, the issue isn't the headline number. It's the interest burden that compounds on top of it. Servicing that burden requires more borrowing, More borrowing requires more issuance. More issuance strains confidence. And eventually the system begins feeding on itself. In the US, interest expense has grown into a structural force. Public fiscal trackers show annual interest costs approaching levels that can no longer be brushed off as secondary. When debt service reaches that scale, policy options narrow. Cut rates too aggressively, and inflation risk resurfaces. Keep rates elevated, and stress builds elsewhere. Either way, confidence becomes fragile. And when confidence wobbles, hard assets get repriced. That stress isn't isolated. It shows up in bond markets first, because bonds are where confidence lives. For decades, bonds were treated as the stabilizer, the portfolio ballast that offsets risk. But that assumption depends on a world where debt issuance doesn't overwhelm demand. When long-term yields rise sharply, bond prices fall, and portfolios built on old correlations start behaving in unexpected ways. That's when people realize their hedges aren't hedging. This isn't uniquely American. Japan's policy decisions ripple globally. Europe's struggle with stagnation bleeds into currency markets. Emerging market instability pulls capital in competing directions. You can see a strong dollar on one scoreboard and a weakening purchasing power story on another. That's why gold and silver can rise without the dollar collapsing in the way people expect. Different measures, different realities. Layered on top of that is the industrial side of silver, which has quietly become central rather than peripheral. Recent demand breakdowns show industrial use pressing into record territory, even as other categories fluctuate. Electronics, electrical systems, and energy-related applications have been particularly strong. This matters because industrial buyers don't speculate. They secure supply. And secured supply doesn't come back to the market easily. At the same time, the silver market has been running structural deficits for years. Industry surveys continue to project shortfalls, with cumulative gaps building across multiple years. When inventories draw down in that environment, price becomes hypersensitive. Small disruptions produce outsized moves. That's not hype. That's math meeting reality. You've likely seen chatter about manufacturers negotiating supply earlier than usual, locking in metal tied to electronics, energy hardware, and advanced manufacturing. Not every viral claim can be verified instantly, but the direction is clear. End users are uneasy, and uneasy end users don't wait for confirmation. They act. Social media loves exaggeration, so you'll also hear claims that a single country controls most of global silver. That's sloppy thinking. The silver supply chain is complex. Mining, refining, fabrication, and end use are spread across regions. No single actor controls everything. But large buyers don't need total control to tighten a market. They only need to pressure the margin. And in a thin market, the margin is where price breaks. Now let's talk mechanics, because this is where days like this feel chaotic. In fast moves, exchanges often raise margin requirements. This isn't moral judgment, it's risk management. But it forces leveraged traders to either post more collateral or reduce positions. That creates violent whipsaws as leverage gets flushed. Sometimes margin hikes cool a rally. Sometimes they create dips that stronger hands absorb. Either way, they reveal stress. You see similar signals at the dealer level. Minimum order sizes appear, processing delays increase, buyback rules tighten. These aren't random inconveniences. They reflect the cost and risk of replacing inventory during a fast move. When funds pause inflows or halt trading on silver-linked products, it's another pressure valve releasing. Retail demand pushes products away from their references. Liquidity thins, plumbing clogs, price discovery becomes raw. Where do sellers come from in this environment? The same place they always do. Fear and fatigue. Many people treat metals like trades rather than insurance. They sell strength to lock in gains, then feel betrayed when price continues. If that's happened to you, the lesson isn't shame, it's clarity. If your reason for owning hasn't changed, a fast candle shouldn't force a fast decision. This ties directly into the bond narrative again. Rising yields don't just impact governments. They affect every asset priced off the risk-free rate. When the stabilizer destabilizes, portfolios scramble. That scramble often redirects attention toward assets with no counterparty risk. That's not fear, that's adaptation. You'll also hear bold claims from digital finance about becoming the next reserve layer, sometimes backed by metals. Ambition is not infrastructure. A reserve system isn't just about holding assets. It's about settlement, trust, and behavior under stress. But the signal matters. When even digital systems lean toward tangible backing, it tells you something about shifting confidence. Mainstream explanations will keep it tidy. Geopolitics, softer currencies, central bank buying. None of that is wrong, it's just incomplete. The deeper story is that people are watching rules change in real time. Trade uncertainty, policy volatility, and sudden shocks don't just move markets, they alter planning. And when planning becomes difficult, collateral becomes valuable. This is also about rotation. When speculative corners cool, capital looks for history and liquidity. Gold and silver fit that role. It's not always panic. Sometimes it's repositioning. And when repositioning meets thin supply, price moves faster than narratives can adjust. Comparisons to past episodes often miss the point. The world today is more connected, more leveraged, and more industrially dependent on silver than in prior cycles. Add persistent deficits to that mix, and rallies stop being just speculative froth. They become inventory stress expressing itself through price. A parabolic move doesn't guarantee collapse. Markets crash when leverage crowds in, and marginal buyers disappear. Pullbacks are possible, even likely. But pullbacks test conviction, not truth. The goal isn't perfection, it's survivability through volatility. And this brings us back to the core question. Are you reacting to noise, or are you responding to structure? Because the structure unfolding here isn't finished. It's evolving. And how you navigate it will matter far more than whether you caught the exact bottom or top of a single candle. At this point in the cycle, the hardest thing to do is separate noise from signal because both arrive at the same time and both feel urgent. Price flashes, headlines escalate, opinions multiply, and suddenly everyone sounds confident. But confidence in markets is often loudest right before mistakes are made. The real edge comes from slowing down and identifying which pressures are structural and which are temporary reactions to stress. One of the clearest structural pressures right now is the role silver plays beyond finance. It isn't just a monetary metal, it's an industrial input woven into modern infrastructure. Electronics, power systems, medical equipment, chemical processes, and renewable energy all rely on it. Solar, in particular, matters not because of a single factory or a single country, but because of a global build-out that consumes real metal year after year. Even with efficiency gains, that demand doesn't disappear, it compounds. Forward-looking demand models reflect this. Several projections extending toward the end of the decade show industrial consumption continuing to rise while mine supply struggles to respond quickly. New mines take years to bring online, capital investment fluctuates, and grades don't improve on command. That mismatch doesn't guarantee a straight line higher, but it does explain why sentiment shifts can trigger violent repricing. When buffers are thin, price becomes the shock absorber. On the monetary side, the picture is just as layered. Recent gold demand data shows global demand hitting record levels, with investment demand surging even as official sector buying cooled slightly from its peak. That isn't a reversal, it's a handoff. Central banks accumulated aggressively earlier, and now investors are stepping in more forcefully. Slower accumulation doesn't mean abandonment, it means diversification strategies are already in motion. This matters because narratives often lag behavior. By the time a consensus explanation forms, positioning has already shifted. That's why watching inventory behavior, deficit data, and volatility often tells you more than watching pundits argue. When markets feel unstable, people don't wait for permission to protect themselves, they move first and justify later. So where does that leave someone trying to make sense of this moment? It leaves you with decisions that aren't binary. This isn't about all in or all out, it's about alignment. If you sold recently and feel that familiar knot of regret tightening, the worst response is chasing price blindly. That compounds the original error. Step back. Revisit why you owned the metal in the first place. If your thesis was protection against currency dilution and systemic stress, that thesis didn't evaporate because price accelerated. If you're holding, the risk flips. Greed can become as dangerous as fear. Fast markets reward discipline, not bravado. Have predefined levels. Know what would make you reduce exposure. Know what would make you add. Decisions made in advance are always cleaner than decisions made under pressure. For those still trying to understand whether this move is real or fleeting, watch the stress indicators. Deficits don't lie. Volatility doesn't lie. Premium behavior doesn't lie. Policy constraints don't lie. These are the breadcrumbs that reveal whether a move is speculation or repricing. Price alone can mislead. Structure rarely does. There's also a personal element that rarely gets discussed. How you emotionally respond to volatility says more about your strategy than any chart. If a sharp dip fills you with dread, you may be overexposed. If it excites you, you may understand the asset you're holding. Neither reaction is moral, they're diagnostic. It's also important to recognize that markets don't exist in isolation from politics and policy. Leaders talk about strong currencies because it sounds reassuring. Markets care about purchasing power. Leaders talk about growth. Markets watch debt issuance. Leaders talk about rate cuts. Markets watch the long end of the bond curve. When speeches and incentives diverge, incentives win. This divergence is why comparisons to past cycles often fail. The financial system today is more interconnected, more leveraged, and more dependent on continuous confidence than it was decades ago. Information moves faster, capital moves faster, stress propagates faster, and silver sits at a unique intersection of these forces. It's monetary enough to reflect confidence shifts and industrial enough to reflect real-world demand. The idea that a high price automatically means a top is a comforting myth. Markets top when participation becomes one-sided and leverage overwhelms liquidity. That condition can develop at low prices or high prices. It depends on behavior, not numbers. Yes, sharp pullbacks are possible. They're part of silver's nature. But pullbacks test commitment. They don't invalidate structure. This is also where portfolio assumptions get challenged. Many strategies were built on the idea that bonds smooth volatility. When that assumption weakens, diversification has to be rethought. Assets without counterparty risk regain relevance. Not because they promise returns, but because they promise independence from someone else's balance sheet. You'll continue to hear debates about whether this is inflation, disinflation, or something in between. Labels don't move markets. Incentives do. When servicing debt becomes expensive, policy flexibility shrinks. When flexibility shrinks, confidence becomes fragile. When confidence becomes fragile, tangible assets get repriced. This doesn't mean collapse is inevitable. It means stability has a cost. And that cost shows up in assets that cannot be created with keystrokes. Silver doesn't need a catastrophe to justify interest. It only needs uncertainty to persist. There are also practical developments worth noting. Online dealers adjusting order rules, longer shipping times, tighter buyback policies. These are operational responses to stress, not marketing gimmicks. Short covering events that create vertical candles. Funds pausing products when retail demand overwhelms structure. None of these events alone define a cycle. Together they sketch one. The industrial narrative continues quietly in the background. Even as some sectors slow, electrification, grid upgrades, and advanced manufacturing continue to pull on silver supply. That demand doesn't care about sentiment, it cares about delivery. And delivery is where theory meets reality. At the same time, regulatory frameworks around digital finance are evolving. Governments want oversight, markets want innovation. Somewhere between those forces lies the future infrastructure. And increasingly, that infrastructure gestures back toward hard collateral. Not out of nostalgia, but out of necessity. Trust scales better when it's anchored. So what matters most right now isn't predicting the next dollar move. It's understanding the environment. We're in a period where confidence is being tested across currencies, debt markets, and portfolio models. Silver is reacting not because it's fashionable, but because it sits at the crossroads of those tests. The biggest mistake in moments like this is assuming today's price action tells the entire story. It doesn't. Today is one page. The larger narrative is about what the world chooses to trust when certainty fades, currency promises, debt obligations, or assets that exist outside policy discretion. Watch the next few sessions closely. Not just the price, but the reaction to price. Do dips get bought quickly? Do premiums hold? Do inventories tighten? Does volatility stay elevated? Those answers will tell you more than any single forecast. And remember this: markets are designed to make the majority uncomfortable. They move fastest when consensus is split and confidence is thin. The calm decision rarely feels exciting in the moment, but it often looks brilliant in hindsight. The repricing happening now isn't just about silver, it's about confidence in the frameworks people relied on for decades. When those frameworks wobble, assets that can't be printed don't drift higher, they adjust abruptly. That adjustment doesn't ask permission, and it doesn't announce when it's finished. So stay analytical, stay patient. Let structure guide you, not emotion. Because when the dust settles, it won't be the loudest voices that were right. It will be the ones who understood why the pressure was building long before the release.